Hi, Dr. Scott here. Excited to have you back to learn more about financial accounting. And this time we're going to be talking about the financial statements, four principal statements, and the relationships. We'll do a much deeper dive into relating the balance sheet to the income statement. In the nature of accounting, you've heard of the accounting equation where assets equals liabilities plus equity. So let's first go through and ask some questions of, let's go ChatGPT to get some help here. Tell me about the accounting equation. Absolutely. You've heard it before. Assets equal liability plus owner equity. Assets, what the business owns. Liabilities, what the business owes. And equity, that's the ownership interest. And again, you can do a deeper dive as you see fit. Let's see what it says for financial statements. What are the if I can spell that right, financial statements? Let's see what we got. Great question. So we start with the income statement, also known as profit and loss statement, also sometimes called the statement of operations. Also, there's other names, but those are the principal ones. Shows the company revenues and expenses over a period of time. I'm going to emphasize period of time with that because the balance sheet's a point in time, and we'll see why that makes it matters in where we go. Revenue minus expenses is net income. There we go. Accounting equation. It keeps our balance sheet in balance. That's why the heck we call it a balance sheet. Statement of cash flow. I don't have a good acronym other than OIF. Operating, investing, and financing activity. So operating is the main operations of the business. Investing is the stuff you buy like equipment or invest into the business or invest in other businesses. Those are usually assets. Then financing is the debt we incur to finance those assets or to finance operations. We'll have equity, we sell stock, or we sell debt. We'll issue bonds or any other kind of debt to help pay for the business. And finally, statement of owner's equity or retained earnings, beginning equity, owner's investments, net income, withdrawals, and ending equity. We'll go through that in some more detail. I just want to give you the big picture of where we're headed and what we're doing all this. And again, AI, actually, I will tell you that AI has a pretty cool study and learn mode that it would be very helpful. I'll point it out right now here. Let me just do a new chat. If you are going into the study and learn mode, free version is in the first screen, but here, study and learn, it actually lets you ask questions, pop in problems, pop in exercises and things you're trying to do. And normally it won't give you a direct answer. It'll help you process. It's called the Socratic method, where it goes back and forth with you. So I'm going to encourage you to use that study and learn mode, experiment with it. I think it can be really helpful in getting ahead in understanding the stuff. All right, so let's go back and let's talk about the statements, and I'm going to hone in on the balance sheet and the income statement. So I'm going to go ahead and we're going to go to the whiteboard. New whiteboard. And you saw, I'm going to hand draw here. Actually, let's go down here. Blue, like a little thicker. I know it would be a little good. Okay, there we go. So I got assets, liabilities, and equity. And on my income statement, I have revenues and expenses. I get a bottom line, hopefully net income or possibly net loss. Here I get total assets equals total liabilities plus total equity. So we got the accounting equation. We got things that we know need to balance. This is called the balance sheet. Don't mind the acronym. We got the income statement. So let's go through and let's do some transactions to see how this big picture feels and fits. So I'm going to go into text mode here, and I'm going to say we have an initial investment by our investors. We're not going to issue debt. We're going to issue equity. We're going to issue stock. So I'm going to say common stock. And I'm going to put in a number like, let's put $50,000 into the hopper. So we get $50,000, 50K. Now I'm going to do cash up here. Text there, cash, 50K. We're going to see debits and credits pretty soon. But for right now, just be aware that we have $50,000 on the asset side of the house. We have $50,000 on the equity side of the house and zero in liabilities. So now I go spend some money. Do I have any revenue or expenses yet? No, that 50,000 is not revenue, that's an investment. Let me go buy some inventory. I'm actually going to buy some inventory. And to do that, let's say we get $20,000 inventory. Okay, inventory, $20,000. And we're gonna have to change our cash amount because that's $20,000 down. So I'm gonna have 30,000 left in cash. So my question to you is, what do I have in expenses so far? Well, some of you would be tempted to say 20. Some of you would be tempted to say 0. And the answer is, it depends. Is that confusing? It could be. It depends is going to be a common answer for lots of problems in accounting. The reality is it really is not expenses. We didn't put any expenses here on the income statement. We bought inventory. We haven't sold it yet. We own it. Basically, the assets, as I said earlier, were the things that we own. The liabilities are the things we owe. And then we have the ownership interest, which includes the profits, which we'll see how it gets there in a minute. So if I'm looking at this screen, I'm saying cash basis, cash out is an expense. Cash in is a revenue, but we're not cash basis. We are following the rules of GAAP, generally accepted accounting principles. And GAAP says use the accrual method, not the cash. Okay. So if we look at that, we're saying, okay, I got to use the accrual. So we might have receivables, accounts receivable, we might have accounts payable, we might have other things going on. But the whole point is, I can't record an expense. We learned some of the concepts of matching principle. Until I generate a revenue item, I can't record an expense item to go with that for my cost of goods sold. So if I'm looking at this, I'm saying, okay, that's kind of cool. But am I in balance? Yeah, I have one asset go down, one asset go up, no change to liabilities, no change to equity. We're in balance. Life is good. I still have zero revenue and zero expenses. There's another account I want to talk about in the equity section called retained earnings. And retained earnings is what is a result, and I'll do the formula here. We'll look at what beginning retained earnings. Let's see. We get beginning retained earnings, which started at 0 right now. We're going to add net income, or subtract net loss. There's sometimes losses. We're going to subtract dividends or payouts to owners. And we're going to end up with ending retained earnings. Because right now we're going to generate a sale. Let's say we go do some consulting. We go outside and say, maybe an architect, a lawyer, an accountant. I'm going to do some services for you. And I'm an accountant. I'm going to do $10,000 worth of stuff. So I am going to generate $10,000 worth of revenue. So that 10,000 is going to go into revenue. And I'm going to get 10,000 in cash. Let's say you just paid it right away, whoever the customer is. I'll take it. And let's go over here. We're going to change our cash. We now have $40,000. And you're going to say, but Scott, I can add. I've got 60,000 in assets. I get 50,000 equity. I get 0 in liabilities. You're lying to me. You're not keeping a balance sheet in balance. Well, we will get it in balance. What's our net income here? Well, I've got 10,000 in revenue. I've got 0 in expenses. I'm going to have net income, $10,000. I'm going to put my 10K right here. And then I go over here and I look at this formula. Oh, yeah, I remember now. Beginning retained earnings. I'm going to do this right here. My beginning retained earnings happens to be, let's do that over here. Text it in, get it lined up a little better. Okay. I have 0 beginning retained earnings, but I have 10,000 in net income. I have zero in dividends, and I combine that all, I get $10,000 for ending retained earnings, which means I'm going to put $10,000 right there. Okay, so let's go back, put the text in here, and I'm no longer a liar because I got a balance sheet that's in balance. I was invited to be a temporary controller for a company outside of Madison, about 40 employees. A friend of mine was the interim president, and they had books that were challenged. They were so challenged when I got there, the balance sheet didn't balance. That was obviously the first thing I had to address. I'll also point out that they were losing money. And based on what you learn in managerial accounting, I was able in about 3 minutes to calculate a break-even point of sales revenue they needed I looked at their income statement. I said, hey, you're losing money based on what your gross profit is, based on what your cost of goods sold, based on expenses. You hit this number, you will break even. And that's this number in revenue. And sure enough, 3 months later, they hit that number in revenue, they were break even. Following month, they exceeded that and they were at a profit. So these numbers actually mean something and do things. I'm going to do one more advanced transaction here. Let's say we're Best Buy. I like using Best Buy. And we're going to sell a TV. We're Best Buy selling a TV to a customer. So the cost of the TV, let's see what we got. Well, let's describe it here. Sell TV sell for $400. Oops. And our cost, $300. So we're going to go for this double entry because every transaction, has two sides: cash and equity, cash and inventory, revenue and cash. So if I sell a TV for $400 and our cost is $300, I know my gross profit is going to be $100 before all my other expenses. I can do that in my head, and so can you. Well, what do we do this for a transaction? Where do we put the 400 and where do we put the 300? Well, the 400's got to go in two places. The 300's got to go in two places. So let's think about that. What two places? Is our $300 is coming out of where? Oh, it's coming out of inventory. We have our revenue going to be $400. That's going over here in our revenue. I got two of the items, but I got four I got to account for. I got two 400s and two 300s. So let's say we sold this on credit. What's the term that we use for credit? Well, we call it accounts receivable. They are not accounts payable. That's things we owe. But accounts receivable is things owed to us. So our customer owes us $400. And let's find out a little bit. Yeah, we'll do 400 there. Okay. And we're going to have TV revenue of, let's get that going. TV revenue of 400. Now notice what just happened. I had 400 increase in assets. I had no change to liabilities. I'm going to have a change to equity. I have to have a change to equity. We'll see that in a minute. I have $400 going in revenue and zero in expenses right now. So I've got another $400 on my bottom line net income. That $400 gets added to retained earnings. So as soon as I enter a sale, it washes right up through net income into my retained earnings and shows up my balance sheet. But that's not quite the full picture. I told you I had $300 in inventory that had to go out the door. So I'm going to put in an adjustment here for inventory do it like accountants do it, parentheses, 300. That means my assets are down 300. My liabilities don't change. And my equity will change also because I'm going to put something called my cost of goods sold or cost of products sold or cost of sales of 300. And when you look at that, you say, oh, that makes sense. 400 minus 300, I got 100 net income. And you'll remember when we looked at inventory before, we said inventory was not an expense until we sell it. So we're pulling it out of inventory. So now we have 19,700 in inventory. You can do the math. We now have 300 of that for the TV that we sold, 400 for the revenue. So our net income is now $100. So we're back in business. We're back in balance. Our retained earnings now is reflecting 10,000 plus the 400 minus the 300. So we're at 10,100, and that keeps us in balance across the board. So hopefully that highlights what it looks like when we're doing business and we're in a situation where we have sales of products that we buy from others like inventory or that we produce. Maybe we're Ford or Stellantis and we're going out and we're creating inventory from building cars, trucks, or vans. And when we do that, we're going to have our inventory sitting on the balance sheet, and anything we can basically convert to cash or has value and we'll talk about prepaid and unearned revenue later on, but anything with a value is an asset that we can convert to cash or use up. Or like prepaid insurance is an asset. We paid in advance. We haven't expensed it. Maybe we had $1,000 insurance policy for the year. We paid the $1,000 out. We've got prepaid insurance as an asset. And then every month we're going to take out a portion of that and use it up until we don't have it anymore, or we don't have to pay it anymore. We cancel the policy. So I wanted to give you the big picture of how this relates, because it's really important to understand that two sides to every transaction, or in this case, four sides to some transactions, and the relationship between the income statement and the balance sheet. Hoping that was helpful, hoping that made sense, and I'm available for any questions you might have. So is ChatGPT, and so is Grok, and so is Gemini, and so is Claude, and so are all these other tools that are at your disposal. But take advantage and let's learn together. Thank you for your time.